Hello, and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management.
And I'm Daniel Kohen, U.S. Policy Strategist in the Global Investment Office.
We're recording this audiocast on Tuesday, April 29th. Today, we'll explore the key developments in U.S. policy under the new administration and the implications for individual investors. Let's dive right in. Daniel, can you give us some perspective and a framework for how to think about the rapid pace of policymaking we have experienced in recent months?
Thanks, Monica. Look, the speed of policymaking has been unprecedented. Trump has signed over 130 executive orders, the most in the first 100 days of any president, which has introduced record high levels of policy and trade uncertainty, as well as market volatility. The key to our thesis since Election Day has been about watching both policy sequencing and the magnitude of those policies. Unlike Trump's first presidential term, when policies were first stimulative and then restrictive, his second term has emphasized restrictive policies first. Budget cuts and tariff policies have been the initial priority, while pro-growth policies are expected in the second half of 2025 and into 2026, as businesses are positioned to benefit from lower taxes and deregulation. Tariff policy generated significant market volatility, with uncertainty still lingering. However, we can categorize tariffs into three distinct buckets: universal, sectoral, and reciprocal, each with distinct purposes such as revenue generation and trade imbalance correction. While the magnitude of tariffs and a trade policy framework remain unknown, it has led to concerns about slower economic growth and potential increases in inflation. Importantly, the 90-day pause on reciprocal tariffs, which expires on July 9th, aligns with the timing in which Congress is likely to consider the 2025 budget and address the debt ceiling, as certain tariffs are likely to be used to partially fund the budget. What this means for investors is that once a final budget bill is passed, an increased level of clarity around taxes, tariffs, and debt and deficits could be introduced, which could reduce market volatility.
So, Daniel, it sounds like that despite all of the activity coming out of Washington, some policy clarity could come in the third or fourth quarter of this year. And while we wait for that day to arrive, let's discuss some of the implications that the last 100 days could have on market activity. Recent equity market volatility and negative stock performance was thought by some investors to catalyze a tariff policy reversal. This was not the case. Rather, the bond market's reaction to tariff developments, particularly the rise in interest rates and impact to credit default swaps, reflected concerns about the U.S.'s fiscal stability and prompted trade policy relief. While the recent pause has been welcomed by markets, we caution investors that continued tariff uncertainty and the potential for economic pressure could pose challenges for corporate margins, especially given high valuations and earning expectations that came at the start of the year. That said, it is critical to monitor sector-specific exposure to tariff risk. Technology, materials, energy, and industrials are particularly exposed to tariffs as they have foreign revenue exposures as high as 57%, while defensive sectors like utilities and certain healthcare companies may face lower tariff risk as underlying corporate performance is more insulated from trade. Furthermore, tariff risks reinforce our preference for service-oriented industries over consumer goods. And importantly, diversification across asset classes and regions remains a crucial tool in navigating volatile markets. For a more in-depth discussion at the intersection of policy markets and the economy, please ask your Morgan Stanley financial advisor for copies of our most recent U.S. Policy Pulse report. As always, thank you for listening.